We are in the final stretch of what has been an absolutely wild year for the markets. Before we get into the meat of the financial data, I want to address something that's been circulating. Lately, some other analysts, specifically the economic ninja, have been making some pretty strange claims. He's suggested that people are only selling silver because I'm telling them to, and he's even gone so far as to claim that I'm an AI. It's interesting that he thinks so little of your intelligence. To suggest that you can't tell the difference between a real perspective and a bot is a bit insulting, don't you think? Maybe instead of worrying about me, he should ask why people are looking for alternative viewpoints in the first place. When someone spends their time pushing free webinars that are really just sales pitches for expensive courses, it's hard to take their concern for the common person seriously. Whether you're a veteran trying to cover rent, a student working at McDonald's, or a struggling homeowner, you deserve straight talk, not a sales funnel. So, let's get back to the truth of what's actually happening. The $74.6 billion smoke signal. If you thought the fireworks were over, think again. We are currently watching a financial inferno break out in the banking system. Breaking news just hit the wires. Banks have tapped the Federal Reserve's Standing Repo Facility, SRF, for a staggering $74.6 billion in overnight liquidity. To put that in perspective, this isn't just a high number, it's a record. They are pledging treasuries and mortgage-backed securities just to get enough cash to keep the lights on overnight. Now, the official story from the mainstream media is that this is just year-end pressure. They'll tell you it's just banks cleaning up their balance sheets for the holidays. But we've had year-ends before. This isn't a routine adjustment. Just a few days ago, this usage was sitting around $25 billion. It tripled in a matter of hours on the final trading day of the year. Why? Because something is breaking under the surface, and that something is the silver market. Silver, the accelerant in the engine room. Silver has been on an absolute tear this year. We've seen spot prices spike toward $80 an ounce, even briefly touching $83.62 before a small pullback. We are looking at annual gains of nearly 150%. Silver is outperforming gold by a massive margin, and that is creating a nightmare for the big banks. The underlying story is explosive. China currently controls about 70% of the global refined silver supply, and they are locking it down with export bans starting January 1st. Manufacturers are panicking. We are seeing reports of 44 tons of physical silver being pulled out of vaults in a single morning. While the banks are trying to suppress the price by raising margins on the CME, it's like trying to put out a forest fire with a garden hose. The big bullion players, names like JP Morgan, Citi, and Bank of America, are heavily short on silver derivatives. When the price of silver goes up, these banks lose billions. The margin call meteor shower. According to CFTC data, banks were net short about 212 million ounces in silver futures earlier this month. As prices exploded, margin calls started raining down on these institutions. JP Morgan alone holds hundreds of billions in precious metals derivatives. If silver keeps squeezing, those short positions turn into black holes that suck up all the available liquidity. This repo surge is no coincidence. The Fed is stepping in as the lender of last resort because these banks can't find the cash they need in the private markets to meet their obligations. The Fed even removed the limits on this repo facility earlier this month. They knew the stress was coming. They are essentially printing liquidity to keep the engine from seizing up, but the smoke is already pouring out of the engine room. Why this is history in the making. The mainstream media will keep telling you that everything is calm, but the mechanics of the market are clearly breaking down. We have a paper-to-physical ratio that some estimate is as high as 400 to 1. This means for every 400 ounces of silver traded on paper, there is only one actual physical ounce in the vault to back it up. When China pulls the plug on exports, the emperor suddenly has no clothes. Banks have to rush to cover their positions, but there isn't enough physical silver to buy without sending the price to the moon. This is a five-alarm fire in the silver pits, and it is spreading to the rest of the financial system. For those of us holding the physical metal, this chaos is actually a signal of strength. Short squeezes like this don't end with a whimper, they end with an explosion. We could see silver rocket to $150 or more as we move into 2026. While gold might hit $5,000, silver is the underdog that is ready to outperform almost every other asset class. Understanding the repo safety net. Let's look closer at the repo facility itself. Normally, banks trade cash with each other overnight. But when banks stop trusting each other, or when they run out of spare cash because they're tied up in losing silver bets, they go to the Fed. They hand over their government bonds as collateral and get cash in return. The fact that they needed $74.6 billion, shattering the previous record of $50 billion set back in October, is a massive red flag. This is the highest usage we've seen since the height of the 2020 crisis. It means the interbank lending market is gasping for air. As the fiat system struggles, silver is rising from the ashes. We saw something similar with the Hunt brothers in 1980, but this time it's global. It's not just two brothers, it's China, it's tech demand, it's AI, and it's a perpetual deficit. This is the second half of our deep dive into the silver derivatives meltdown and the repo market spike. In part one, we talked about the $74.6 billion red flag at the Fed and how the year-end excuse doesn't hold water. Now let's look at the how and the why. Specifically, the game the big banks have been playing and why it is finally blowing up in their faces. To really grasp why the banking system is sweating right now, you have to understand the bullion bank playbook. For decades, institutions like JP Morgan, HSBC, and Citi have built empires on paper silver. These aren't just bars of metal sitting in a vault. They are a mountain of derivatives, swaps, and futures. The goal of this paper system was simple: keep the price suppressed so the big players could accumulate physical silver on the cheap. But 2025 and the start of 2026 have changed the rules. Silver started last year at $30 and ended at north of $80. That is a 150% gain. For a bank holding a massive short position, every dollar silver goes up represents billions in losses. The China export crunch. While the banks were trying to manage their paper losses, a geopolitical bomb went off. Starting today, January 1st, 2026, China has officially implemented new export licensing requirements for refined silver. China produces about 70% of the world's refined silver. They've realized that silver isn't just a shiny metal for investors. It is a strategic resource essential for the tech wars. By tightening these licenses, they could effectively cut off 60 to 70% of the silver the West relies on to fill its supply deficits. Even Elon Musk has pointed out that silver is a non-negotiable component for Tesla and SpaceX. Without Chinese silver, the Western tech industry faces a massive wall. The gamma squeeze. Gasoline on the fire. In the trading world, we are seeing something called a gamma squeeze. When investors start buying call options, bets that the price will go up, the market makers, who are often these same big banks, are forced to buy silver futures to hedge their risk. As the price rises, they have to buy even more to stay balanced. It creates a feedback loop that sends prices vertical. We saw hints of this in December when silver ripped to $83. The banks are getting caught in a trap of their own making. Their derivatives books are now bleeding red, and the $74.6 billion repo hit is the cash they need to cover the margin calls on those losing bets, breaking the arbitrage. Normally, banks make money on the spread, the difference in price between London, New York, and Shanghai. But China's move has shattered that system. Premiums in Shanghai are already $3 to $5 higher than in New York. Usually, a trader would just ship metal to where the price is higher to pocket the difference. But with China's new export controls, that metal isn't moving. The arbitrage is broken. This is leading to backwardation, where people are paying a massive premium just to get silver delivered today rather than waiting for the future. It is a clear sign of a physical shortage, mapping the path to $150 and beyond. So, where do we go from here? The mainstream media wants you to believe this is a bubble, but the fundamentals tell a different story. Industrial demand. Solar needs 20% more silver every year. Electric vehicles and AI data centers are guzzling the metal for its conductivity. The supply gap. We are looking at a projected deficit of 265 million ounces for 2026. The gold to silver ratio. Historically, this ratio tells us if silver is cheap compared to gold. Even at $80, silver is still incredibly undervalued compared to where gold is trading. My outlook remains very bullish. While we might see a small pullback to the $65–70 range as traders take profits, the floor is rising. Once the reality of the China export ban hits the supply chain in Q1, I expect silver to move toward $100 and eventually $150 by mid-2026. If the deficits continue to widen, $200 isn't out of the question. How to position your portfolio. In a meltdown like this, the smart money is moving out of paper and into physical assets. Here is how I am looking at it. 1. Physical silver. First, nothing beats bars and coins in your own possession. When the paper market decouples from the physical market, you want the real thing. 2. Strategic mining stocks. Names like Hecla or First Majestic can offer a lot of juice to a portfolio, but they come with more volatility. 3. Avoid excessive leverage. Volatility like we saw this week can wipe out leveraged traders in minutes. Stick to a solid stack and stay patient. 4. Watch the Fed. As long as the Fed is pumping tens of billions into the repo market, you know the banking system is under stress. That is the ultimate buy signal for hard assets. The bottom line. The 5-alarm fire in the silver pits is only getting hotter. The banks are begging the Fed for cash, while physical silver is being drained from vaults at record speeds. We are watching the end of a multi-decade suppression scheme. The banks might be burning, but for those who hold the metal, this is an era of incredible opportunity. Stay sharp. Keep your eye on the vault data and don't let the mainstream media talk you out of your position.